Economist Harry Dent is making a dire prediction about the market next year. He says 2024 is going to bring, and I'm quoting him now, the biggest crash of our lifetime.
Bankruptcies are on the rise, leaving many individuals and businesses struggling to stay afloat. Welcome back to Finance Foresight. Companies are filing for bankruptcy now at the fastest rate since 2020. Bed Bath & Beyond filed this year. Party City filed, Vice Media, Instant Pot, and Pyrex. The list really goes on. And by all accounts, there's more to come. The stakes are high.
Debt grows. Credit crunch out.
Debt defaults like this tend to come in cycles like in 2008.
We're in the midst of a serious financial crisis.
On the start of the pandemic, when Washington stepped in, slashing interest rates, so that companies on the brink could get cheap money. We saw company after company taking on more and more debt. All this access to debt bought companies time, but it also kicked the can down the road. Nobody knows how long the pain will last.
Prepared to raise rates further if appropriate and intend to hold policy at a restrictive level.
The record surge in interest rates is at the root of the issue. Global companies have borrowed more than $500 billion of investment-grade debt since the Fed's rate hikes began in 2022. The vast majority of this was heaped onto U.S. balance sheets, and despite the high borrowing costs, debt continues to grow.
It's really been building over the course of the last year. Interest rates have increased, cash flows have declined.
By mid-2023, blue-chip names saw their borrowing costs rise by more than double to an average of 5.6%, while junk-rated companies were paying 8.7%.
With rates potentially staying high for a longer period of time, we could see a longer cycle that may not necessarily be tied to the macroeconomy.
The problem is in part that this is a little bit by design. The Federal Reserve wants to slow down inflation. Interest rates were kept higher for longer than a lot of economists and people on Wall Street expected. This higher rate environment has created a mountain of distressed debt.
Distressed debt is generally bonds. They are tradable. Bonds that originally sold for $100 are selling for $20 or $15 or $5.
There's more than $200 billion of distressed debt in the U.S., and that's more than the GDP of some European countries. Since 2021, this sort of debt owed by riskier, less creditworthy businesses has jumped around 400%. Retailers are especially vulnerable. Inflation keeps their costs high, even as consumer spending slows. By mid-2023, the consumer industry accounted for more than a fifth of bankruptcy filings.
Most bankruptcies don't occur because you have a business and it loses money. A business borrows money. Times get tough, and when it goes to refinance that loan, the bank says you're not as good a credit as you used to be, or we don't have as much money to lend as we used to have, or our standards are higher.
The hope in bankruptcy is that the doors are kept open. Everyone is kept employed, but we're seeing more and more liquidations, which basically means that all of the stores need to be shut down.
For consumer-facing companies and those upstream supplying them, that will impact their businesses.
So you can kind of have this domino effect, and that can have huge impacts on communities
And those can be pretty difficult, particularly if they have a lot of space.
Retailers use bankruptcy to get out of leases without having to pay large sums of money to the landlord.
Which leads us to commercial real estate. Remote work plus online shopping have helped increase vacancies, unlike home loans. In conclusion, the surge in bankruptcies highlights the urgent need for actionable steps to navigate these challenging financial waters. By prioritizing your financial health, building an emergency fund, seeking professional advice, and staying informed, you can protect yourself during these turbulent times. Remember, prevention is better than cure, and taking proactive measures can go a long way in safeguarding your financial well-being. And if you haven't, please subscribe and leave a like for this video. Your support helps us continue our work. Thank you for joining us today on Finance Foresight.